Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Anthony, how are you?
I am doing well, and I'm excited to get back to the basics. A lot of our previous podcasts have been about ways to create passive income and, of course, some taxes. It's been a while since we started diving deeper into becoming your own banker. In this section, Cameron, this is my second favorite section of the book.
I would agree. This is certainly up there for myself. And what we're talking about is we're talking about page 51, which is entitled Equipment Financing. And this is where Nelson is starting to take us into some examples of what it looks like when we use these policies.
Yeah.
So let's get started. What do you think?
Let's do it.
Yeah. All right. So we got to page 51, Equipment Financing. When we're thinking of this is, man, we probably could have called this section a couple different things. I was actually going to be a little creative and call it Gofers, Bloodsuckers, and Clowns.
Oh,
Nelson,
I like it.
Nelson is a little aggressive in this piece. He has a couple names for some people, so I thought that was curious. And then the other piece, which is probably more practical, is the other name I was going to call it, is going to be businesses come and go, but banking is eternal. And that's a direct quote for Nelson on page 52. So what Nelson is talking to us right here on page 52 about is he's saying that whatever business or whatever career you're doing, you need to be doing that, and then you also should be in the business of finance or the business of banking. And so that's what we're going to dive into here.
And with this section, there's a lot of numbers and examples in the book. So what we've done is, it's going to be hard to convey that through a podcast. What we've done is we've created a video where we do a deeper dive through the illustrations that he's going about. So that link will be in the show notes. For this right here, we're just going to be talking big picture, right?
Yeah, absolutely. And what would you say is kind of a main theme for this section here, Anthony, if you had to communicate that to somebody?
I think the main theme is that he does some examples of an illustration without banking, which we've called the do nothing illustration. And then he has some other illustrations where he's actually banking. And to me, and this is why this is my second favorite piece, is because here Nelson illustrates that the power of IBC is not in the insurance company. It's going to be in the concept of IBC and how you use it. And I'm sure you've heard of the 80-20 rule.
Absolutely.
Right?
Yeah.
You know, you get 80% of your results for 20% of the work, or maybe you're in an organization, 20% of the people do 80% of the work. What I found here is that this also relates to the 80-20 rule. And what I say is that 20% of the results are going to be based on the product. 80% are the process. So that product, the product is the life insurance policy, aka the insurance company. And 80% of your results are going to be from the process or the infinite banking concept or how you use it. Because oftentimes people get hung up on what companies we're using, right, Cameron?
Absolutely.
Right. And really, as the important thing is, it's more how you use it than what company you are using for. Like with the companies that we use, I mean, they've all been they're 100 years or older. They pay dividends every one of those 100 years. They support IBC, and of course, they are a mutual company. Now, when we're looking at what company to use, we're really doing it. There's really two things that we look at. One is how you're going to use it, because maybe some people want to dump a lot of money up front, and there's some companies that are great for that. But then if maybe there's some other things you want to use it for, there may be some better companies. So it's really going to be like how you're going to use it and the flexibility that you need in your deposits. But also, one thing I'm running into now is, we work with some people. I've been getting in with a lot of pilots, and some of them are doing, maybe they're in the reserves of the Army, or they're doing some contract work. So different carriers will look at different things. So, but the reason why I like this example is that it's all about how you use it. Nelson doesn't focus so much on the company. It's really more the concept.
Absolutely. So let's dive in here. Let's jump to page 54, which is going to be illustration number 1. And on this page, right, Anthony already introduced us. This is kind of the do-nothing policy, the do-nothing illustration. What numbers as we go through, because we're going to be looking at maybe 3 or 4 of these illustrations, Anthony, is there 1 or 2 of them that we want to pick out and make sure that we share?
Well, I mean, I think it's kind of all about cash flow and retirement. What do you say? I
totally agree. So the only thing I'd add is maybe at age 65, what we're going to do is we're going to look at what that number is and then the amount of income that's coming off of that. You agree?
Sure.
Cool. Okay. So let's do this. Is equipment financing illustration number 1. Like I just mentioned, this is where we have, Nelson has somebody funding a policy for 4 years, $40,000 total, and then they completely stop funding this policy, right? Mm-hmm. So what he tells us is this is just simply a savings account. We're not doing any banking. We're not taking any money out. We're just putting money in and we're letting it sit there. If we fast forward all the way down to age 65, Anthony, how much cash value is in there?
Okay, so I'm going to be the one looking at the numbers, huh? Okay.
No, I will. I'll do.
Okay.
Yeah, I'll turn it over to you in just a sec. But
the amount of cash value that we'd have is going to be $1.5 million.
Okay, and how much cash in retirement are we able to take off of this policy?
$92,000 a year.
Awesome.
Cameron, what's the tax rate on that?
That would be 0.
Okay, exactly. Perfect.
Awesome. So now we've got kind of our framework that we're working off of, right? So the 2 big numbers that we want to take off of this, simply savings account is going to be $1.5 million is what we've accumulated at age 65. And then Nelson's going to have us live out to age 85. So for 20 years, we take $92,000 of passive income off of this policy, correct?
Correct.
Perfect. All right, so let's jump over to page 55, because what Nelson just did, we have the simple savings account, and now what he's going to do is he's going to introduce us, I believe it's his nephew, right, as this nephew has a logging company, and he introduces us, or he reintroduces us to this idea that there's only one pool of money. He first brings this up on page 26 in his book, and he brings it up again here, but he highlights something different. Is he says, listen, there's one pool of money. In this instance, the insurance company has that money. And what he tells us is that the insurance company is the administrator of that money. They don't own it, right? And so, again, he reviews the hierarchy of the policy holders and says the policy owner, right, owns that cash value, can come back and demand that money at any time. And so he reminds us that we are in first position with access to these funds. But then number 2 is he brings in the finance piece, and he says, listen, you have the option to tap into these funds that are sitting at the insurance company, but you know who else is tapping into those funds or has access to those funds, Anthony?
Who?
The banks. And so what he reminds us is he says, okay, listen, the finance company that most people are going to borrow money is turning to insurance companies and borrowing from this pool of money, and then they're turning around and they're lending it out to somebody else. And so, go ahead.
Right. No, like I would say if you're financing equipment, in this example, he's using the Peterbilt trucks, but whatever, if we're in a dental office or whatever equipment you have, they do offer financing. Like, does Peterbilt own a bank?
No.
Right. So, and even when you lease or buy some equipment for your business, they're not banks. They're getting that money from somewhere. And Cameron, where are they getting that money from?
Insurance companies.
Exactly. So what his nephew had said is, wait a minute, I'm funding my policy, and then I'm financing some equipment through my business. Where are they getting the money? They're getting the money from the insurance companies. So it's kind of like he's putting the money over here, and then the company is borrowing it from the insurance company, marking it up and selling it to him for retail.
Absolutely.
Right? At the bottom line, it's his own dollars.
Exactly. So that's what Nelson reminds us. And he says, okay, guys, listen, you have access to this pool of money just like the finance company does. And so now what he's going to do and illustrate moving forward is he's going to say, listen, what if we start to take control of this financing function in our lives. And so the next example that he introduces us to, or first he introduces us to the truck, and he says, okay, my nephew's going to finance a truck, and he talks about the cost of it. So he goes through that. And then in illustration number 2, he says, all right, what is this going to look like if I start financing just one truck using the cash value from my policy, right?
Exactly.
So now we're on page 59. So the two pieces of information that we're kind of comparing here is if we fast forward and we look at, it's the same structure. He's putting in $40,000 for 4 years. And this time, in our first example, just to remind everybody, what was he doing with those dollars? Was he doing anything with them in the first example?
No. Inside the policy, he just put in the policy and did nothing with the cash value.
Okay. So now we're on illustration number 2. What does he do in this example, Anthony?
What he's doing, instead of financing the equipment directly through Peterbilt, what he's doing, he's calling up the Gopher, and that's what Nelson uses. He calls up the insurance company and says, hey, I want to borrow the money to finance my truck. So what he does, he takes the terms that he would have gotten from Peterbilt, and he uses them. He uses the exact same terms to borrow money against his policy. And I think that this is very key component in the infinite banking concept, that if you're going to borrow money, if you're going to use money from one institution and pay them interest, but then you use your own money, if you don't pay the same amount of interest, in essence, what you're telling yourself is that their money is worth more than my money. And if anything, for me, my money, I work really hard for it. My money to me is more valuable than somebody else's money. So when I use my money, I charge myself the same amount I would pay somebody else, and sometimes I will actually charge a little bit more. So what we've done is he's borrowing the same amount of money, but instead of Peterbilt, he's borrowing it from his policy. He's paying back the exact same terms. Instead of those repayments going to Peterbilt, those repayments are going back into his policy. So overall, he has not changed his cash flow a single bit, right?
Nope.
Right? So then we look at, so what he does with this truck, it needs to be replaced about every 4 years. So in this example, every 4 years, he's financing a new truck. And when we look at the last example, you recall we had $95,000 in cash flow in retirement.
Yep.
Now with 2 trucks, we have $150,000 in cash flow.
We have 125.
Ooh. Okay. I'm jumping ahead. I'm so excited for 2 trucks.
So we got 1 truck, and the 2 numbers we're going to look at is age 65. The cash value is going to be 1.98, and then the retirement income that we're taking off is 125,000. That just made my day to fix Anthony's correction. Yeah. So now we've got 1.98 and $125,000 that we're able to take off of this account. Remind the viewers, what was the first number that they had in cash value in the first example? It's okay. It's 1.5 million. 1.5 million and 92,000. This time we've got 1.9 and 125,000. Are you guys seeing the difference here? Anthony, can you share with them a pattern, right? What are we starting to see? How much control did the insurance company have in the first example over the dollars?
They had all the control of the dollars in the first example.
And we ended up with 1.5, and now this guy's taken over a little bit of control by financing 1 truck. And what's happened to that cash value at the end of the day? Has it gone up or down?
It's gone up.
How about the cash value? Has it gone up or down?
It's gone up.
All right, now let's take a look at illustration number 3. Right, illustration number 3 is when the nephew says, okay, how is this policy going to perform if I now finance 2 trucks, right? And so funding is the exact same thing. The only thing that differs is in year number 5 is he's going to take out enough money or borrow enough cash value to go finance 2 trucks, and now he's going to pay himself back, right?
Mm-hmm.
Does the same pattern every 4 years. He's paying it off, and then he finances another one. If we fast forward down to age 65, how much cash value does he have?
Now we have 2.4.
Awesome. And how much is he able to take off in retirement income?
$150,000 a year.
Awesome. And how does that compare to the previous example?
In the previous example, doing 2 trucks, he was able to get $125,000 a year, and he had about $1.9 million in cash value.
Right. Again, so he finances an additional truck, and his cash value goes up at age 65, and his retirement income goes up at age 65 plus, right?
Exactly.
Awesome. So, Anthony, what logical question do you think this nephew is going to ask next?
I have other trucks that I'm financing. Can I just continue this process?
Exactly. So illustration number 4, Nelson says, what does this look like if we were to finance 3 trucks? Exact same thing, funding's the same. Let's fast forward down to age 65. How much cash value does he have now?
He has almost $3 million.
Yep.
And the cash flow is $175,000 a year.
Dang, right? Let's fast forward, right? Illustration number 5. So again, he says, okay, now I kind of see a pattern here, right? This thing's, the more I use it, the better it's going to get. So in illustration 5, what's going on, Anthony?
All he's doing is now he's financing 1 additional truck, and hopefully you realized the cash value at 65 went up about $500,000, and the cash flow now is $225,000.
All right, so now at age 65, we got $3.5 million, and like Anthony just said, we got $225,000 that's coming out in cash flow. So, Anthony, out of all of these examples, which one do you like the most? Which one would you want?
The last one.
Why?
Because it has more cash value in retirement.
Right. And in doing that, getting more cash flow in retirement, did he take on any additional risk?
No risk. If anything, I say he took on less risk.
Explain.
The reason I say that is if you have a loan with a finance company, you have to pay that every single month, or they're going to take the equipment back. That's also going to be on your credit as well. I think it's very interesting now in these times, right now with the whole COVID-19, a lot of businesses are shut down. They don't have cash flow coming in. How are they going to make their loan repayments? If they're using a traditional bank, they're at the mercy of that bank. But when they are their own banker, they have a lot of flexibility. What a lot of my clients are doing now is we are pausing loan payments. And when things pick up, we're not going to, as Nelson would say, steal the peas, meaning that we're still going to pay ourselves back, but we're just going to tack those payments on the end. So this, I think, allows him to take less risk and really be in a better position financially to go through those difficult times.
Great explanation. The other question I'd ask is, did this guy work any harder?
0.
Nope. Right? He was going to be doing this financing along the way. The only thing that he's done is he's brought that financing piece back in-house, right, to a piece where he controls it and owns it, and then also retains the profits. The last piece that I want to share on this thing is, if you look at the numbers on here, is how much on a monthly basis was he able to recapture. If you go back to page 55, and Nelson introduces us to that pool of money, on there he says that his nephew was paying banks $16,000 a month in the form of financing fees and charges, right?
Mm-hmm.
In this last example, when we had 4 trucks and 1 tractor, he was recapturing or sending $9,000 a month back to his own policy, back to his life insurance policy. So even as good as illustration 5 is, he's only operating at about a 60% efficiency, right? He still has more room to go. And one thing that you'll go through, that if you look at, is if you go and you look at age 30 or year 36, age 65, that last year loan repayments is supposed to be $108,000. What it says there, it says $79,000. The reason that it's $79,000 is that because this one singular policy could not hold all of the financing that he was trying to do through this, right? And so this is an additional reason why, one of the many reasons why we have clients that set up additional policies, right? Is because as you start to use this more, the more money you're going to have and the more places you need to put it. And so, right, this is a great introduction to multiple policies, and why we want to use them is if you do this right, one of them is not going to be enough.
Exactly. You know, one thing I just realized, you know, it's amazing. We've read this book so many times, and how many times you read it, I read it about 3 times more than whatever your number is. But
Are you talking to me or the
I'm talking to
listeners?
you.
Okay.
I'm talking to you, Cameron. But
I read it 4 times last night.
Okay. I read it 7. But what just hit me is if you noticed, with every truck, the cash value at 65 was increasing about $500,000. Okay. All he did was finance one truck for $50,000 or 52.
52,600.
Okay, thanks. You sound like a CPA. You wish. But the point I'm trying to make is he financed one vehicle over and over again that was $52,600. But when he turned 65, that increased his cash value 10 times.
Mm.
And again, just like you said, he didn't work any harder. We didn't take on any more risk, and we didn't change his cash flow. All we did was change it from the bank making that money to now his family is making that money. It's deep, right?
Actually, I was just letting you catch up, because what I learned there was that you're a slow learner. This right here is, guys, if you have any questions on this piece, call us. Right? Is because what I wish more people took the time to understand this piece right here. And Nelson, what he does in these 10 pages here is he lays out really the idea of the infinite piece, right? The more you use it, the better it gets. Well, what if I finance something else? What if I finance another tractor? What if I finance a truck? What if I finance that tree shearer? What's going to happen to his cash value? It's just going to continue to increase, right? And continue to grow. And so that's the infinite piece that Nelson is referring to. And that's what we have our firm named after, Infinite Wealth, right? Is because if you do this correctly, it's only going to get better for you, right?
Mm-hmm. Now, just a reminder, we went over a lot of numbers, and Cameron made a video where he goes really down deep and into the lines of the illustrations. So if you want to learn more, I would highly encourage you to check out that video. But really, the bottom line is, if you have a business, you can use this in your business. And I know a lot of people who are like, you know what, I'd just rather pay cash. But if you've been listening to this podcast, we show you mathematically that running something through your policy as opposed to paying cash will allow you to have more money at the end of the day. Right? Because without getting too deep, I don't want to get on a side note here. But remember, when you're borrowing money from your policy, you're not borrowing it from your policy, you're borrowing it against your policy. So your policy is still compounding. So you're still earning that interest. When you're paying cash, every time you buy that asset or spend money, your cash value goes down, your cash goes down to zero. You break that compound interest curve. So if that's something you're still struggling with, we also did a podcast and in a video as well, which we're putting in the show notes, that actually do the math, showing you the difference between buying one asset in cash and one asset through a policy.
Awesome. Thanks for sharing, Anthony. Well, what about you? Do you have anything else to share here? This is some good stuff.
You know, what I would say some of the keynotes is that it's the 80-20 rule. The results are not going to be based on the insurance company. So don't focus so much on what company.
Yeah.
Focus on the concept and how you're going to use it, because that's going to represent 80% of your results.
I totally agree. We get questions all the time on what company we should be using, direct recognition, non-direct recognition, who has the best dividend rates, right? All those things. If clients, would take that energy and those questions and direct it towards, hey, how can I use this cash value?
Mm-hmm.
That's going to be a better question, right? Rather than focusing on just the product. So.
I can't believe we forgot to mention, you guys should check out Nelson's book, Becoming Your Own Banker. And also, we do have an online course, the Infinite Wealth course. In there, we dive in deep through how this concept works, but also some other other concepts in there, like, should I get a 13 or 15 or 30-year mortgage? How do I maximize my cash flow in retirement? So the URL for that is infinitewealthcourse.com. And there's a little video on there, and it'll show you there how to get free access to the course.
Awesome. Thanks. Hope you guys enjoy it.
Make it a great day.
Take care.